Chapter 4, Part 4. Now we're going to look at the cash flow statement using the direct method. And remember, the only thing that's different is operating activity, so that's all I'm going to go over. We're going to look at the same problem. So, again, now we're going to look at the cash effects of each operating activity. So, we always start with figuring out how much actual cash did we receive from customers. Then we're going to subtract cash payments to suppliers for operating activities and income tax. Reminder for the homework to subtract these items from cash received. And that's how we're going to get net cash provided by operating activity. Now let's look at our balance sheet. We need that with the changes. And we also still need the income statement. So we're going to start by figuring out how much cash was provided from customers. Well, two accounts must be analyzed. Sales adjusted for changes in accounts receivable. So we had sales of $950,000. Our accounts receivable went up. And since it went up, that means we have $25,000 in sales that we didn't get money for. So our actual cash received from customers is $925,000. And that would be our first number. Now we're going to look at supplies. Now this is how I like to do it. This is just my approach. You can do it any way you want. What I do is start with the three accounts that are going to affect accounts payable. Cost of goods sold, inventory, and accounts payable. So to figure out how much cash, what I'm first going to do is I'm going to say, okay, if I had a debit to cost of goods sold, which is what shows on the income statement, that means there was a credit to inventory. Now I'm going to figure out how many purchases, how much transferred from added to inventory based on purchases. So I'm going to take my 61,000 minus my 600,000 minus my ending balance, which tells me 614,000 was debited to inventory. And that tells me that accounts payable, it came out of accounts payable because that would have been the offset, right, when they bought it. It would be inventory, accounts payable. So now I'm going to determine the payments. I'm going to say we started with 60, we added, purchased 614,000 more, and we had an ending balance of 66, which means my purchases were 608,000. And always check to make sure your debits equal your credits there, and the ending balance is correct. So now we can go here. Now we can go here and say supplies are 608,000. Now for operating activity, we're going to say I'm going to total the accumulated depreciation for equipment and building, and it started at 42, ended at 58, and we know that we sold something, so we reduced it by 6, which means depreciation expense total was 22,000. So we know we had operating expenses of 250,000, but we have to take out depreciation expense because that's non-cash. We also have to take out the change in allowance for doubtfuls. Because if it went up by 2,000, which is what we're seeing here, it means that they would have debited bad debt expense and credited allowance for doubtfuls. So now we have our cash payments for operating activity. Now we've got to look at income taxes payable. We know we started with 10, we ended with 12, and we had income tax expense of 45, and so that tells us we actually paid 43. Now we add those up. We have $877,000 in expenses subtracted from the cash received, outflow versus inflow, and it tells us our net cash provided by operations is $48,000, which is the same number we showed under the indirect method for part 3. And that ends this presentation and for all of chapter 4.